Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis. A warm welcome to Money Talk on Thursday the 20th of August. As we move towards the end of the week, there's plenty of market action, economic data and business news from the Asia Pacific region to discuss. And as always, this podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 100 million customers across 13 countries. In today's business and finance headlines, the US Treasury said it plans to more than double buybacks of longer-dated bonds, a signal the US wants to lower borrowing costs after yields hit multi-decade highs earlier this week. Yields in the 10-year to the 30-year sector plunged Wednesday following the news. It comes as total US public debt surpassed $40 trillion for the first time and has now surged by a third in less than 5 years as US lawmakers continue to shrug off calls to contend with historically large fiscal deficits. Indonesia's central bank held its policy rate steady in the first monetary policy decision under acting governor Destri Damayanti, who stuck close to past guidance and vowed to uphold the stability of the rupiah. Bank Indonesia left the benchmark BI rate at 5.75% for a second straight month as expected. The central bank had already hiked rates by 100 basis points this year to shore up the currency and investor confidence. A global sell-off in semiconductor stocks rippled through Asia Wednesday as investors retreated from one of the year's hottest trades amid elevated bond yields. South Korea's Kospi index led declines in the region, plunging 5.8% as concern over rising borrowing costs for hyperscalers weighed on sentiment. Shares of Samsung Electronic tumbled 7.8% in Seoul and SK Hynix slumped 9.8%. A gauge of the sector's stocks in Asia was down 3.7% Wednesday, the most in 3 weeks. MSCI's broader benchmark for Asia-Pacific equities slid 2.2%. Unitree Robotics shares rose 629% in its Shanghai trading debut after raising $904 million in an initial public offering that will make it the first publicly traded humanoid robot maker in mainland China. Robots built to move, work and act like humans is a global industry that Morgan Stanley estimates could be worth $5 trillion by 2050. And companies like Unitree have already taken an early lead over the US in production volumes and real-world deployments. I have the perfect panel of guests to discuss that this morning. With me are Andrew Freris, the CEO of Ecognosis Advisory, and Tim Huxley, Chairman of Mandarin Shipping. With a view from Taiwan is Ross Feingold, Director of Research at Caerus Consulting in Taipei. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street's Wednesday, stocks steadied and bonds gained after the US Treasury Department said it would at least double the size of its buyback operations for longer-term notes and bonds. The S&P 500 ended a 3-day losing run, advancing 0.2% to close at 7,708. The Dow added 120 points, or 0.2%, and settled at 53,463. The Nasdaq Composite gained 0.2% to 26,331. The rally lost ground as the session went on. Earlier in the day, the Dow climbed more than 360 points at its high of the session. The S&P 500 was up 0.7% at its peak, while the Nasdaq was higher by 0.6%. Longer-term US Treasury yields pulled back on Wednesday, reversing course from this week's major advance after the Treasury Department announced an increased buyback operation of the nation's debt. The 30-year Treasury bond yield shed 9 basis points to 5.19%, while the 10-year US Treasury note yield lost 6 basis points to trade at 4.64%. The US dollar index resumed its decline, falling 0.9% to around 98.8 on Wednesday, hitting the lowest level since late May. The Japanese yen traded 1% firmer, around 158.1 yen per dollar. The offshore Chinese yuan was 0.2% firmer at 6.73 renminbi per dollar. Precious metals jumped Wednesday, pushing gold to its highest settlement value since May the 29th. Spot gold surged 4.3% to $4,524 a troy ounce. Oil climbed for a fourth day. Brent crude futures rose 0.5% to $91.47 a barrel. And cryptocurrencies rallied, with Bitcoin jumping over 5% to trade just above $69,000. South Korea's Kospi Index led declines in the Asia-Pacific region, plunging 5.8% to 6,471. Japan's Nikkei 225 closed 3.2% lower at 65,326, weighed down by losses in tech stocks, and shares of SoftBank Group declined by 10.3%. Losses in Asian tech shares were particularly heavy in China, where the tech-heavy Chinex in Shenzhen plunged 6.3%. The Star Market's 50 index, predominantly chip makers trading in Shanghai, tumbled 5%. The mainland CSI 300 slid 2.9% to 4,589. In Hong Kong, the Hang Seng Tech Index sank 1.2%. The broader Hang Seng Index rose 24 points or 0.1% to 25,495. Futures markets in Asia Pacific pointing higher this morning. Looks like the Hang Seng is going to jump 0.6% at the open. The Nikkei 225 in Japan set to surge 1.5%.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Time to welcome our Thursday morning guest. We have with us Andrew Freris, the CEO of Ecognosis Advisory. Morning, Andrew.
Good morning, Peter.
And also joining us is Tim Huxley, who is the chairman of Mandarin Shipping. Morning to you, Tim.
Morning, Peter.
Now, as you heard there in the introduction, longer-term US Treasury yields pulled back on Wednesday, reversing course from what had been quite a major advance earlier in the week after the Treasury Department announced an increased buyback operation of the nation's debt. The 30-year Treasury bond yield shed 9 basis points. The 10-year note lost 6 basis points. On Tuesday, the 30-year yield hit a fresh high of above 5.33%, which was its highest level since June 2007. And elsewhere in the world, Japan's 10-year bond reached its highest level in 3 decades this week. German 30-year Bund yields hit their highest points since 2011, and rates on France's 30-year bond reached the highest going back to 2008. Andrew, tell me if I'm misunderstanding this, but this is smoke and mirrors, isn't it? If the Fed is, the Treasury is not the Fed, so it can't print money. So if it is going to buy back longer dated bonds, it has to fund that by selling shorter dated bonds, which is only going to push rates up at the short end. So it doesn't change the amount of debt that overall is owed by the US, which is the reason why yields are high in the first place. Or am I misunderstanding this?
No, you're not actually. We have two separate things, whether the Treasury is doing the operation, as you say, and whether the Fed. The Fed actually, it is not true that it can print money to buy the bonds. It simply exchanges bonds for a deposit with the Fed. Okay, that's a very straightforward banking operation. And that overall increases the liquidity in the market to that extent. Now, with the Fed itself buying, we have to say with the Treasury itself buying, we have to find out where the money comes from. If it's going to, unless it is a pure swap, in which case, as you're saying, Peter is paying Paul.
Mm. And the Treasury hasn't said where it's coming from, have they?
No, they haven't. But I suspect, this could be really ridiculous to say by the Treasury actually saying they're going to borrow the money to do this. But this is absurd because the whole point is not to increase the debt, is actually to decrease the debt, or at least decrease the debt in certain lengths of the yield curve. Now, toying with the yield curve can be absolutely lethal. The Japanese have found out that repeatedly, because the markets, of course, have the uncanny capacity to operate at any part of the yield curve they're interested. And if the concentration is at the top end, then that always raises possibilities of successful trading at any other point across the yield curve. So I'm not quite sure what was this about. It successfully lowered. Let's be very, very fair with them. It successfully lowered the long-term yield.
Temporarily, though, isn't it? Presumably temporarily.
Well, and because I can never have a mind, I can never have a brain good enough to remember numbers, I was just reading that the total that the total national debt in the United States is now 40 trillion,
Yep.
whereas the total deficit for this month is 40 billion. Well, it's nice. Two 40s to remember that these are very, very large sums of money.
Well, Tim, isn't this the issue, isn't it? We are just awash with debt all over the world, wherever you look. In the US, as Andrew just said, the US government debt is now gone above $40 trillion for the first time ever. Japan is sinking in debt, so is the UK. And at some point, this has to be paid for. And maybe we're reaching the point now where you know, the someone's going to want the bills.
Yeah, I mean, what worries me every time I wake up every morning is every single metric seems to be at its highest level since before Lehman's.
Yeah,
and you sort of think, is this sort of precursor to a repeat of all of that? Yeah, I mean, this is a remarkable situation, and if you read beyond the Financial Times, I mean, everybody is saying that Trump needs a big win now. Is he going to get it economically in the States? I don't think so. I mean, there's a lot of thrashing around. I mean, is it going to be an open dialogue with North Korea that's going to sort of give him a big win? But so I don't see if there is any immediate solution to this. And as you say, I mean, this isn't reducing the debt. I mean, it's still going to be there, and but you know, people are blaming this on you know, the legacy of the Iran-Afghanistan war, Biden's push with COVID relief, etc. So they're saying it's a long series that goes back so long, as regards is the cause of it, and. In essence, I don't think there is. I cannot see an immediate solution to this.
Well, I mean, it's true that it has been building up for a long time, but it has accelerated, hasn't it, in recent years, the amount of debt. And this is partly because the US Congress won't do anything about balancing its budget. Each year it has a fiscal deficit which has to be funded, and they don't want to go and cut expenses or raise taxes to deal with that. If anything, the Trump administration is cutting taxes and spending a huge amount of money on this war. So they're just adding to this.
I agree. I mean, there is no immediate solution in sight, and it's almost you know, you're just going to have to continue to kick the can down the road.
Well, this is like, Andrew, this is like Scott Bessent is acting like King Canute here, isn't he? He wants to hold back the tide, but he can't. He's got a huge budget deficit. The market thinks the Fed is not being quick enough in raising rates to combat inflation. So, you know, he said that this is all about liquidity management. We don't believe that, do we? We know the problem is he wants to get long-term yields lower because it costs the US over $1 trillion a year, paid over $1.2 trillion this year to finance that and pay interest rate costs on it. So this surely is not going to work.
There are three things one can examine. Administrations and financial administrators are famously well known of breaking what I could modestly call the reason why you will always fail Andrew Freris's 101 economic course, and that is you can either control the price or the quantity, not both. Okay, so Japan is precisely trying to do that. In a way, okay, Bretton is saying, I want to lower interest rates, okay, therefore I want to see the prices going down, okay, and at the same time, I'm not doing anything in particular to affect the quantity. Okay, they cannot do this. I mean, nobody has ever done that successfully for any time period, except if you do it by administrative means, in which case you move away from the market. And of course, the market will also punish you because they will not buy this. So point number one. Point number two is yes, there is a solution to that. If they want to lower long-term interest rates, they have to cut the debt. And to cut the debt mean not buy back the debt right now, but so that in the future they will be borrowing significantly less. And this can be done only, once again, Andrew Freris' dilemma, if you're having a fiscal policy whereby you increase the taxes and you cut the spending. And you cannot borrow less unless you do a combination of increased taxes and or cut the spending.
Yep.
You cannot have only one. Okay, increase the taxes and continue with the spending, or continue with the spending and not increase the taxes. Sorry, Peter, it is childishly easy and obviously, and it is never obeyed.
You would think so, isn't it? Except the US is doing the opposite. It's cutting taxes and increasing spending.
It's not only United States. China also is doing that in a lot of different areas, and there they have it a little bit easier because, in Japan, of course, because they can physically collect correction, administratively control certain parts of the markets. But with even that, you pay it. At the end, there is no way you will do it if you have a market there, because the market, it won't punish you. The market will simply react in this particular way. Prices goes up, quantity comes down. Quantity goes up, prices come down. Very simple.
There's a casualty to this, isn't there? Isn't the US dollar the casualty of this? Because if the US carries on doing this, it's going to force the US dollar lower. People will want to sell US debt and go elsewhere, and that'll push inflation up as well if the dollar's lower.
The situation with the US dollar has also got a kind of Alice in Wonderland situation, because of course the US dollar is the mark against everything else is trading. And I remember the famous replies, why is the US dollar weak? He says it's because the Japanese yen is strong. And why is the Japanese yen strong? It's because the US dollar is weak. Can you see what I mean? It is a circular reasoning. So yes, the answer is if the interest rate differential versus all the other currencies that the US dollar trades for do not point in a direction that you get paid, okay, for holding the US dollar as opposed to holding anybody else, then you don't hold the US dollar. Terribly simple.
Well, Tim, I mean, there's another element actually to this, isn't there, as to why bond yields are going up, and that is because now there's a lot of competition from corporate borrowers, particularly those companies in the AI sector, which are spending huge amounts now on building data centers all over the place. Trillions of dollars they're spending. They've run out of cash to finance it, so they've got to go and borrow in the markets. I presume other sectors as well, which are big borrowers, also are affected by this. I don't know about the shipping industry. Is the shipping industry very capital intensive and reliant on borrowing in the markets, in which case presumably it will be hit by these higher rates as well?
Well, we seem to be in a doom loop on this borrowing, don't we? I mean, it's is there any end to it? And Andrew, I don't know if you, with your greater experience, if there is any prospect of a rectification of this, or if we're just going to be so obsessed with all the other problems that are going on in the world that this, again, as I said, would just get kicked down the road.
I'm afraid my expectation, and this is what I tell my clients, as rightly, we all sit here and tear our hair, or at least what remains in my head to tear, okay, is what's going to happen with all this debt. And my reaction is if something is going to happen first, it's going to happen in the private sector, for the incredibly simple reason that the United States government cannot go bankrupt, whereas Google, Meta, OpenAI, all of them potentially can go bankrupt, meaning that they will not be able to service their loans. And given, of course, that the markets have got huge doubts about that, then the first crisis is not going to be with the US dollar government bonds. It cannot be, okay, because they're always fundable. But the private sector is not fundable. And unfortunately, the moment that happens, it's going also to hit shares, in the sense that if somebody was worried that the US government is not going to service its bonds, you don't necessarily go immediately and you sell all your shares. But if you're feeling that a large section of the private sector, particularly the AI section, will not be able to service its loan, then of course you will also sell their shares. You'll not be sitting on their shares. So, okay, my reaction to that is yes, something will need to happen, and what is going to happen first is the private sector. Hence, I'm actually, in a perverse sense, I'm telling my clients to carry on positioning themselves if they want a reasonable income on the long end of the US government bond yields, but stay out of US government, of private sector, US dollar, United States shares.
Okay. Well, look, let's move on and talk a bit about the Middle East conflict. Tim, I want to get your thoughts. Since we last spoke about this, things have moved on a bit. We were in that 60-day negotiating window, weren't they, where Iran and the US were going to try and extend the ceasefire. That appears to have collapsed. Donald Trump has ruled out extending that ceasefire. He says he's not even talking to Iran anymore. He's threatening to bomb Oman if the Gulf nation gets in the way of talks with Iran. According to him, this doesn't seem to be any closer to a resolution.
Yeah, I think that this is actually now, this really is quite a critical phase. I mean, there isn't apparently so much actual shooting going on, but the implications are getting more and more serious as they pass. I mean, there seems to be an absolute impasse as regards what's now seemingly the key issue, which is free transit through the Straits of Hormuz. And both sides are being very intransigent on this. But whilst there might be less actual military action on the ground, I mean, there is still fighting going on. I mean, a Greek bulk carrier was hit earlier this week, and sadly, one person was killed on board. So it is still highly hazardous, but it's now beginning to have a big impact, I think, on the broader economy. I mean, in many respects, none of us have actually had to queue up at gas stations. Yes, energy prices are going up, but I think it's going to have a bigger impact because now, when this started, one of the key factors was that China had substantial stocks of oil. Mm-hmm. Now then, in the second quarter, China's imports they were down 30%, and whilst the imports of crude oil, they dropped, the actual amount that was being produced by refineries in terms of gasoline, diesel, everything like that, it didn't drop nearly so much. So what you're seeing now is you've got a substantial drawdown on the strategic stockpiles that you had in China. And when you combine that with the fact that the oil flows out of the Middle East are conservatively down about 5 to 6 million barrels a day, it does mean that as we go into the winter and increased demand with sort of fuel in the Northern Hemisphere winter, then we could actually be heading for a crunch unless there is a resolution on this sometime soon. And to be honest, both sides are being pretty intransigent. So I'm not sure about it. What you are seeing is a huge amount of sourcing of oil from other markets. And if you look at, say, the oil tanker market, I mean, exports out of West Africa and Brazil and indeed the US have all been increasing quite substantially. And the cost of moving those, it all comes through into inflation. I mean, the cost of moving an oil tanker from West Africa to Europe has gone up from about $70,000 a day a couple of weeks ago to now over $160,000. So it is beginning to have an impact. Whilst there might not be the headline news, and it's fascinating looking at a British newspaper this morning, there's nothing about Iran in the first sort of couple of pages. I mean, it's all about, Harry and Meghan returning to the UK, critical issues like that. But
you have to stop reading The Sun, that's why.
Yeah, there are going to be quite serious inflationary impacts and economic impacts from this conflict going on. I mean, we talked about the US debt being impacted by the Iraq war, the Afghan war, COVID. I mean, these things have a long tail, and it's going to take a long time to sort this out.
Do you agree with that, Andrew? Do you think maybe we've run out of luck here? In the early days of the war, in the first few months, although there were all sorts of dire predictions about the impact on the global economy, it never really came to pass, did it? And that was partly because the oil price didn't really remain elevated for a long period of time, because we had, as Tim was saying, China importing less and digging into its stockpiles. Are we running out of luck now in that's no longer going to be possible, and therefore we are going to see oil elevated for a long period of time, and that's going to have a much bigger economic consequence now?
I passionately think not. And I'm hanging all this, and I'm going to pay the price at some stage, possibly, on, I'm sorry, this is me saying, I told you so several months ago, and I don't mean that at all. My reaction is this obsession with Hormuz led to a very strong impact, and we've seen Tim giving us some idea about that, of bypassing Hormuz in three different ways. Nothing in this world, Peter, is not substitutable. Okay, everything has a substitute. Everything. It has a cost. Okay, and my forecast is within 1 year, Hormuz will be irrelevant. In other words, it would have been bypassed in several different ways. One is you can always ship oil not via Hormuz from different places. And Tim told us examples about West African, about United States exportation. And of course, even Venezuela and even India came in very strange ways to produce substitutability of the Hormuz bound or the Hormuz oil. And the other part is of course, this is bypassing it through landlines. Saudi Arabia is very active on that, and that's going to take a while. It possibly is going to take years, but the longer the Iranians stupidly continue to chokehold it, the sooner the time will come that they will be choking a dead chicken. In other words, there would have been nothing to get out of that. So, yeah, I do believe that oil prices may well increase, but I don't believe that this is going to lead to a crisis with the oil prices going up as we were told at the time, to 160, 170, even 200. No, they won't. Okay, because the Hormuz effect will fade out slowly, causing cost. Okay.
Let's get Tim's thoughts on that. I mean, we're seeing data, or I've seen data, which says only 3 ships a day now are going through the Strait of Hormuz, although maybe there's others, ships that are going dark and going through it and not being captured by the data. But are we seeing this happening already, that, traffic through the strait has collapsed, and we're getting to the point where firms are looking for alternative ways and making alternative arrangements, and we're never going to get back to where we were before on shipping traffic through the Strait of Hormuz, and Hormuz being as important as it used to be?
Yeah, I mean, traffic has absolutely slowed to a virtual standstill. I mean, on a really, really good day now, you might get 12 ships going through. Now, that's down from over 120 when things are normal. I think what has been quite fascinating has been the realignment of the whole supply chain of oil. Yes, we've lost a huge amount. I mean, as I said, Middle East flows are down 5 to 6 million barrels a day. And of course, it's not just oil we're talking about here. I mean, the Middle East imports a lot of its food, and we talked earlier on this program about exports of fertilizers. So it's having a big impact on a lot of other different trades. But you've got now a lot of oil is being exported through Fujairah in south of Oman. So it's not actually having to go through the straits, but that's a smaller pipeline. You've got huge investments in pipelines coming up over the next few years, China had announced that it's going to develop a huge pipeline network, and that will create an enormous demand for steel and new infrastructure there. So is there going to be a fundamental change to the whole supply chain? It will take a long time to come through, but for sure, people are working on that. The one laggard on the whole of this seems to be the UK making a decision to sort of open up the North Sea again. They're importing all of their energy from places like Norway, and a lot of it's coming from the Middle East. UK was very dependent on gas from Qatar, but they're still dragging their feet on developing their own natural resources. So I think that whilst we're talking about the trillions of debt that is in the world, on the basis of what's happened this year and looking at it, energy security has got to be the top priority for every government and really for businesses in general. Are we actually going to have the energy to continue to drive our economies?
Well, I mean, if you look at China, the speed which they're reducing their dependency upon oil and oil-based products and moving to clean energy, and the amount of electric cars you see on the streets now, I mean, that's one way. But it does take time, though, doesn't it? That's the problem. I mean, they've been doing this for years. There's other countries that haven't even started, like the US.
Yeah, I mean, time's probably the one thing we haven't got here. To bring all of these things on stream is going to take not just a long time, it's going to take a massive investment. And if we got that much debt, are we going to be able to do it?
Well, Andrew, I mean, that's the issue, isn't it? I mean, you say that, everything is substitutable, but, it's the time it takes, isn't it? So in the meantime, while we wait for those routes to be substituted and alternatives to be found, are we going to have to go through some sort of economic crisis before we get there?
Well, the economic crisis will be that it is going to cost more and it's going to impact inflation. Yeah. I'm not being flippant here, okay, because, of course, the flippancy comes that whatever happens, the cost of all these are going to be paid by the poor, not by the wealthy. In other words, high oil prices are going to be reflected ultimately, okay, on things that affect people's daily life, as opposed to having some issues. Like Tim mentioned, the issues of fertilizer. This is completely tangential, but I will say it, Peter, because I think it might be interesting for your audience. It is stunning the speed by which Brazil and Argentina change their crop rotation and change what they produce when the price of fertilizers change. It is absolutely amazing. There are crops that they are very fertilizer dependent, one of which is soya, and crops that they are less fertilizer dependent, like cereals, like corn and like wheat. Well, now, when the relative price of fertilizer change, guess what happens? They change what they are producing. And it is absolutely amazing. That's what I mean by substitute. I'm not saying that Brazil stop producing soya and produces corn, because that's completely irrelevant. The two markets are completely different. But the proportion of of what is going through that is amazing, because then it affects the relative prices. So people say, fertilizers went up. The prices of food is going to go up. Whoa, which food and which prices? And you may find out, in fact, that the impact of the changes in the prices of fertilizer to food is not as direct or as obvious as people think it is. I was absolutely stunned by the speed that this happened with specific time periods. And I'm sure it's happening right now, because both Brazil and Argentina do have two crops for certain goods. They have two crops a year, so they can change very quickly.
I mean, there may be, there is a lot of focus on the oil price, isn't there? And as you suggest, it's not just the oil price that we should look at. But then, if you look at, for example, diesel, which, has a huge impact on industry and agriculture in the US, that's close to a record high as well now. So you do feel, don't you, that some of these large economies like the US are going to be feeling the impact of this pretty soon?
Oh God, I sound like an economist. The answer is a yes and no, because at the same time, the United States is now the single biggest exporter of oil. And in a market with high oil prices, they benefit.
Yeah.
So I could tell you what, but I said the poor will always pay for that. Okay, that's why I am flippant to saying, yeah, prices are going to increase, and good luck to them. They voted for Trump, so they're going to pay the price for that. Good. So let's move on. But in terms of a crisis, I prefer to think the impact of that on funding and the impact of that on loans. And I still keep sticking, if I have to make a bet and say where I'm going to run away from, screaming, get away, this is terrible, is the debt of the artificial intelligence companies.
Okay.
Not the US government deficit.
Well, we'll have to leave that for another time. Final thoughts from you, Tim, on maybe the impact on the shipping industry overall. And wondering also, there were lots of ships trapped, weren't there, in the Straits of Hormuz and the Red Sea for long periods of time with crews on board as well. What's happened to them? Are they now being moved out?
The older ships. Well, it's at the moment, and again, we're looking at sort of comparing everything to pre-Lehman crises. I mean, there are reports out the global ship order book growth has hit fastest pace since pre-Lehman boom. So we've got more ships being built now. So we've got to replace everything. But I mean, we've got more ships on order that is needed probably for replacement. So what we need is we need trade growth in trade, which on the basis of what you guys have been saying earlier, looks a bit of a challenge. But yeah, I mean, people ordering new ships, that's 27% up. And it's manageable at the moment. But if there's one thing that has also been noticeable this year, and we had earlier on, remember the great, it was yet another initiative coming out of the White House of Make American Shipbuilding Great Again. So whilst there's been a 27% growth this year in the global shipbuilding order book, there's been negligible growth. In fact, I think you can count it on the fingers of one hand in terms of commercial export ships ordered in the United States. So that hasn't worked. Yeah, we're still in the throes of, China dominates that market. And I think that'll continue.
And China dominating trade at the moment as well. It has a trade surplus with almost everyone in almost every sector. Now it's about the only part of the economy that's sort of firing at the moment.
Yeah, I mean, there's until we get some of these crises sorted out, I think the global trade, it's sort of slightly caught in the headlights.
Okay, well, look, it's great to hear your thoughts this morning on these weighty topics. Thank you very much indeed. That was Tim Huxley, who is the chairman of Mandarin Shipping, and you also heard Andrew Freris, the CEO of Ecognosis Advisory. It's time now to join Ross Feingold, who is Director of Research at Caerus Consulting in Taiwan. Morning, Ross.
Good morning.
Now, South Korea is halving the duration of its defence drills with the United States after Donald Trump ordered a substantial reduction in American participation. He's reportedly seeking a summit instead with North Korean leader Kim Jong-un. What's the thinking behind this, do you think, from the White House?
I think it was always on President Trump's foreign policy to list for his second term to revisit his initiative with Kim Jong-un from his first term. He did get, of course, an enormous amount of media attention, but I think also some praise for pursuing it, at least the first time or the second time they met. But ultimately, it proved to be totally fruitless. No agreements were reached. North Korea was not willing to make concessions as far as inspections and transparency for its nuclear weapons research program. So ultimately, nothing came out of the initiative other than the buzz and the hope that accompanied the meetings. But I think he wanted to try it again. He wants to get that Nobel Peace Prize. Obviously, other global events have intervened in the time he's been in the White House since January of 2025, most notably, of course, Iran. But also in his first year, he did spend a lot of time on Ukraine and Russia. There were other conflicts that intervened on his foreign policy schedule, like Cambodia, Thailand, and other conflicts he got involved in mediating. So he wants to try it if he could fit it into his busy schedule. And I guess as part of that, he thinks that reducing the scale of bilateral exercises with South Korea is some kind of opening or effort at an opening towards North Korea.
It's tortuous reasoning, isn't it? Because there's a real contrast here between his approach to Iran and his approach to North Korea. With Iran, he's absolutely adamant that they can't have nuclear weapons, whereas North Korea, which reportedly is developing nuclear weapons, Trump says absolutely nothing about.
Well, the distinction I think a lot of people would make is in the case of Iran, the United States has been trying to prevent Iran from actually reaching the point where they do possess nuclear weapons. And unfortunately, North Korea has already crossed that point. They actually
Yeah,
do
but
have
he could stop them going any further, couldn't he?
well, the risk is profile is different simply because North Korea already does possess them, and I don't think South Korea is saying please bomb North Korea's nuclear facilities. So of course the United States has to take into account the views of South Korea as far as whether a military attack would be the path to choose. Look, the United States, we know, looked at that option for a long, long time, going back to the 90s and the early part of this century, such as during the second Bush administration. But ultimately, for lack of a better description, that option, it's just too late to pursue it. So the approach is totally different.
He can't really think, though, that North Korea is a more reliable ally than South Korea, can he? I mean, South Korea's been an ally for decades of the US. It's supported the US. They've done joint drills together for a long time. Can he really think that there can be a relationship with North Korea that can even come close to matching the relationship with South Korea?
Certainly, some of these comments from President Trump, whether on Truth Social or responding to reporters' questions, is going to be extremely frustrating for South Korea for the reasons you identified. I'm sure South Korea's leadership is thinking, we've done almost everything you've asked of us as far as, and I'm referring to in recent years, increased military spending, going back to the first Trump administration, as well as increasing the cost sharing for the U.S. military presence in South Korea, or increasing the portion of those costs that South Korea pays for rather than the United States. More recently, with the trade agreement and the concessions that South Korea made to the Trump administration. So that must be very, very frustrating for South Korea. But at the same time, they've seen it before. Going back to the first Trump administration, they know that there's going to be some volatility there. But life goes on. They do what they have to do, whether it's to protect their country from the threat posed by North Korea, or increasingly, in the view of experts in South Korea, the threat from China. And on the trade side, they negotiate with the U.S., do their best to maintain their interests, while also pursuing more trade with other partners as well. So very frustrating. I certainly don't deny that for South Korea, but they've been there before.
Doesn't it send a signal that really the US is just not a reliable ally anymore, and South Korea and other countries in the region really have to look closely at how much they want to rely on the US and maybe come up with alternatives, perhaps working more closely with each other? Japan, South Korea, Philippines, Australia, New Zealand, maybe coming up with maybe an unwritten alliance of sorts to look after their own interests, because it's absolutely clear that under Donald Trump, they can't rely on the US.
Well, as I mentioned a couple of minutes ago, countries are going to do what they think is best to protect their national security, as well as their economy and their trade relationships. And that would, of course, include relationships with partners other than the United States. But that's in addition to the partnerships with the United States. Look, no mainstream politician on the left or the right of South Korea's political divide at the moment is saying that South Korea should seek to end its defense treaty with the United States, or eject American troops because they're not dependable. Nobody's seriously suggesting that. At least at the moment, nobody's suggesting that South Korea should junk the trade agreement that they made with the Trump administration last year. Again, I just don't see that from the mainstream on either the left or the right. Yeah, I mean, of course they'll pursue some other or expanded trade ties, but their important trade partner is still the United States, and their important security partner is definitely the United States. That's just not going to change.
Do you know, I actually think that South Korea should junk its trade agreement with the US. It was totally egregious in the first place. But look, you know, the US was extremely lucky to get that commitment of investment from South Korea. It's going to create an enormous amount of jobs in the US. The US ought to be grateful for it, not treating South Korea in the way it is. I mean, you couldn't blame South Korea if they were to junk that trade agreement, could you?
Well, these trade agreements are broadly speaking similar in the sense that whether it's the EU, Japan, South Korea, or Taiwan, these trade agreements lower tariffs and remove market access barriers for American goods and services entering those markets. It requires those trading partners to pay higher tariffs when their goods go into the United States versus the past, although not as high as Trump threatened. And for those four trading partners that I mentioned, EU, Japan, South Korea, Taiwan, it comes with a massive investment commitment, hundreds of billions of dollars. So sure, those agreements are much better deals for the U.S. than they are for those trading partners. But the threat that existed if they didn't make those deals was significantly higher tariffs. So again, I don't see any signals yet in South Korea of a movement to junk the trade deal, and instead of making the investments, that they should instead pay higher tariffs on their goods that are exported to the U.S. But I'll tell you, Peter, there are definitely people who have made that argument over the past year or so since these deals were reached with South Korea, Japan, or the European Union, and earlier this year, Taiwan, that actually those countries would have been better off subsidizing their exporters than paying or than making the hundreds of billions of dollars of investments. You know, just the cost of subsidies for their exporters would have been lower to make up for the higher tariffs. But that's not the route they pursued. And at the moment, I don't see a signal that they're going to junk the trade agreement.
Now, what's happening in the Middle East? It's going horribly wrong for Donald Trump there, isn't it, really? This is a war now that is looking more and more like one that isn't going to end. The ceasefire, 60-day ceasefire has ended. Trump has said he has no interest in extending it at all. He's also saying he's not even talking to Iran at the moment and is threatening even to bomb Oman if it gets in the way. I mean, this is not how it was supposed to be after 6 months, was it?
We're going to have to wait until the books come out when these people leave government, because somebody must have told President Trump that this is going to end through the use of American military power. This is going to end within a few weeks or 2 months, and Iran will make significant concessions. So the key thing at the moment, because it's August 20th as we speak, the key thing for President Trump is he doesn't want hostilities to be ongoing as the election approaches. He certainly doesn't want hostilities to be going on the day of the election at the beginning of November. So he does have this political concern and urgency. Reach a deal or start hostilities again now, but he'd still have to end them with or without a positive outcome for the United States long before election day, because again, it's just too risky politically for there to be fighting ongoing as the election approaches or on election day itself. So politics, or domestic U.S. politics, are definitely intervening at the moment, and you know, everything I just said is actually it's related, of course, but it's not on point to what would be the framework of a deal for the two sides to formally end hostilities. Can American military power reach the goals that President Trump wants? But the politics are just intervening now.
Are voters going to punish him at the midterm elections? Obviously, he's not on the ballot himself, but nevertheless, are they going to punish Republicans? We had a poll from the FT over the weekend which said most US voters say they're actually worse off under Donald Trump, and particularly their finances have deteriorated since Trump returned to the White House. Even 20% of Republicans are saying it now.
I have President Trump on the line, Peter. He's saying you're citing a fake news poll.
Well, these are independent polls, aren't they, to be fair?
Sure. President Trump is certainly worried about all these issues now causing poor outcome for Republicans. Notwithstanding, it was always difficult for the Democrats to win the House. Difficult to win the Senate. The House expected to be close, and potentially the Democrats could take over the House by a few seats. It's really unlikely that it would be a repeat of 2018 when there was a huge wave victory for the Democrats in the House. And that's because of the redistricting that's taken place and made very, very few districts actually competitive anymore. I think he's prepared for it, though. If it happens, he'll just continue to use executive power, which in many cases has been endorsed by the Supreme Court, the use of such power in ways that his predecessors didn't use it. He'll focus on foreign policy, like a lot of lame duck second-term presidents do in their final couple of years, and he'll think about whether or not he's going to seriously intervene in the Republican primary to select the nominee for 2028. He's not going to be thrilled if he loses control of the House and or the Senate, but I think he's prepared for it already, even though he won't admit it.
That's Ross Feingold, who is Director of Research at Caerus Consulting in Taiwan.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. Do please take a look at my newsletter at peterlewismoneytalk.substack.com for more information on today's top business stories across Asia. I'm here again tomorrow, and I'll be joined by Francis Lun, the CEO of Venture Smart Asia, and Mark Toe, Managing Director of Asset Management at the Wing Fung Financial Group. With a view from Sydney is Australian business and economics analyst Toby Lawson. See you tomorrow.
Money Talk